Have you ever felt like investing is a game only the experts win? One moment the market is soaring, and the next it crashes. You're left thinking, is this even worth it? Well, what if I told you there's a smarter way to invest? One that doesn't require you to predict the future or time the market perfectly? Today, we're unlocking that secret. And trust me, this simple strategy can transform how you invest forever. Stick with me, because by the end of this video, you'll know how to invest in a way that could save you thousands of dollars and a ton of stress without needing a PhD in finance. Let's break it down. Imagine having a big chunk of money you want to invest. Maybe it's your savings or your bonus, for example. Now you could invest all that money today, but what if the market drops tomorrow? This is where dollar cost averaging comes in. Dollar cost averaging is simple. Instead of investing everything at once, you invest smaller amounts consistently over time, like on the same day every month. No more worrying about whether today is the right time. Over time, the ups and downs of the market average out, and you end up buying more shares when prices are low and fewer when they're high. And here's a fun fact. There's a way dollar cost averaging can help you sleep better at night, but I'll get to that in just a second. Let's get real. Investing is as much about your emotions as it is about the numbers. Many people make the mistake of thinking they can time the market. But here's the thing, nobody can predict the market, not even the experts. Imagine you saved for months and finally invested all your savings. The next day, the stock market tanks. What's the first thing you do? Panic. You might even sell, thinking you've lost everything. That's what happens when emotions take over. People panic sell when markets fall, and people buy when markets are at all-time high. Next, we will hear from the best investor there is, Warren Buffett, about emotions and investing.
Now, you don't want to be a no-emotion person in all of your life, but you definitely want to be a no-emotion person in making an investment or business decision.
Now let's look at why emotional decisions happen in investing and how to avoid it. That is partly because of fear of missing out. Dollar cost averaging saves you from that stress because it doesn't matter what the market is doing on any given day. You're investing steadily regardless. But what if you could take all the guesswork and the fear out of investing? So how do you actually start dollar cost averaging? Here's the simplest way. Decide on a fixed amount you're comfortable investing every month. You could set it on the day you get paid, so it's automatic. You don't need to worry about how the market is performing. Just invest consistently month after month. You're buying fewer shares when prices are high and more when they drop, because the amount of money you invest monthly is the same. Now that you know how to invest regularly, there's another key step: diversification. It's just a fancy way of saying, don't put all your eggs in one basket. The easiest way to diversify is through low-cost index funds. These funds own a little piece of a lot of different companies, so you don't have to guess which single stock will do well. With dollar cost averaging, you're already spreading your risk over time, but you should also spread it across different investments to minimize your losses. Coming up, I'll share the common mistakes people make, even with dollar cost averaging, and how to avoid them. Let's clear up a misconception. Dollar cost averaging isn't a get-rich-quick scheme. It doesn't guarantee profits, but it does protect you from making huge mistakes, like investing all your money right before a market crash. Another thing, some people think DCA means you can forget about your investments entirely. While you don't need to monitor the market every day, you do need to check in every so often to make sure your portfolio still matches your goals. We need to discuss the alternatives to DCA before we tell the secret about dollar cost averaging in the conclusion. Trying to time the market is when you try to buy a stock just before it goes up and possibly sell them before they go down. Much easier said than done. Here you see perfectly how hard it is trying to time the market and not investing regularly. By missing only the 10 best days of trading days in 10 years, your annual return has halved, which means missing only one day on average every 12 months. And the other example is, if you try to time the market and miss only the 5 best trading days every 12 months, you would lose money every year. Here we have a visual that explains it. This is why we do not recommend the investment strategy of timing the market. This ties to the emotional side of investing that we discussed earlier. Investors could leave and miss the worst days, but studies show people generally stop investing when the market is down and only start investing when the market has bounced back, meaning they missed the opportunity. Here's where things get interesting. Stick with me to learn when not to use dollar cost averaging. There are times when a lump sum strategy might be better, like when you get a big bonus or inheritance. In these cases, some experienced investors prefer to invest everything at once, especially if they believe the market is headed upward. Or as a beginner, we would take an hybrid strategy, investing part of the money all at once and using DCA for the rest. Now you ask, so what is the best strategy for most people? Now here's something that might surprise you. The type of dollar cost averaging we're talking about, the one where you invest a set amount each month, like from your salary, is actually a kind of lump sum investing in disguise. Think about it. Every month, when you get paid and invest the same amount, you're lump sum investing in that moment. Let me explain. Traditional lump sum investing means taking one big chunk of money and investing it all at once. With DCA, you're spreading out your investments over time. But when you consistently invest from your salary each month, you're essentially making a lump sum investment for that specific month. You're combining the best of both strategies. You're getting the benefit of lump sum investing each month by putting your money to work immediately. So you're not holding on to cash, waiting for the perfect time. You're also dollar cost averaging because you keep adding to your investment steadily over time, which helps manage risk. For many of us, the reality is that we don't have a giant windfall to invest all at once. Our investment money comes from our income, month by month. So this strategy allows us to maximize the power of both DCA and lump sum investing. Here's that secret I promised earlier. A DCA helps you sleep better at night because it takes the pressure off. You're not stressing about picking the perfect time to invest, and you're not constantly checking to see if the market is up or down. You know you're making consistent progress. And over time, this steady approach can actually beat trying to outsmart the market. It's simple, it's consistent, and it helps you invest without the stress. Set your plan, stick to it, and watch your money grow. If this helped you feel more confident about starting your investing journey, hit that like button and subscribe. Our channel's goal is to make you an expert when it comes to your money. See you soon, and thank you for watching.
The information provided in this video is for informational purposes only and does not constitute financial advice. Investing in any form of financial asset involves significant risk, including the potential loss of all your assets. It's essential to conduct thorough research and consider financial situation before making any investment decisions.